Guys, what I want to do today, I want to show you how to build a all-weather concentrated portfolio, okay? So that you never have to worry about the market conditions, okay? And you're gonna be profitable, and your money is gonna be available to you whenever you need it. Now, I created a portfolio by the name Master. Like you see here, this is a portfolio I have saved on Seeking Alpha, which is the website that I use the most for all my reference, and I believe it is the best. Okay, no affiliation. Regardless, what you guys want to do is build a concentrated portfolio. Guys, there is a huge chance that you are not a stock picker. I'm not, and that you are not a good market timer. I am not. Okay, so what do? You want to put yourself in a position where, regardless of what the market does, you're gonna profit from it. Now, how do you do it? And why do I say that it's gonna be concentrated? I do believe that if you have more than 5 or 6 individual stocks, you are doing it wrong. If you have more than 6 individual stocks, you are possibly better off just buying the S&P 500 index. I believe that this has been proved times and times again, and you don't want to make the same mistakes. I do believe that even 3 or 4 individual stocks, it's enough, okay? Like, I remember watching a Warren Buffett's interview where he said that imagine that you have a punch card. You are only allowed to punch it 20 times in your lifetime. In that case, you are really gonna pay attention to what you do with that punch card. The same thing applies to your stock portfolio, okay? So here I'm going to go through what I have, and those are 20 positions. There are only 20, but you can achieve the same with 10. And now I'm gonna explain to you why. Having 20 is gonna to diversify your portfolio, but it doesn't really matter. It is important that you are consistent. It is important that you have an income, and it is important that you buy with consistency the same amount of the same dollar amount. If you do it every week, every month, every other month, it doesn't matter as long as you stick to the plan. Now, this is gonna be a portfolio which I use as a base. This is my base, okay? And in this portfolio, you'll see individual stocks, especially growth stocks, okay? And that's gonna be where you capture the appreciation when the market goes up. Then you'll see there are gonna be here ETFs. There is going to be bonds and T-bills and dividend stocks. Okay, now I am gonna go through all of this with you guys, and I'm gonna give you a reason why this is really gonna work regardless of what the market does. Now, it is important that you understand that markets go in cycles, okay? And there is a short-term cycle and a long-term cycle or secular cycle, okay? Now, we haven't been in a bona fide bear market since the financial recession of 2008, 2009. There was a double dip recession, which the stock market dipped the first time end of September, beginning of October 2008, and then I believe the bottom was March 2009, okay? But since March 2009, we haven't had a bear market. We've had the pandemic, and I believe there we just got briefly into a bear market for a day. I wouldn't even consider that being a bear market. And the 2022 was a down year for the market. But again, we didn't really get into a bear market there. And most recently, the US-Israel against Iran war, where the Nasdaq got into correction territory, dropping 10% from its highs. But regardless, we haven't had a true bear market in a very long time. So how do you invest? And how do you protect yourself from losing money now that stock market is back to its all-time highs? Okay, so you're gonna have to have a combination of things in your portfolio. And now I'm gonna go through those things with you guys. Now, if you guys are big into stocks, that is fine. If you are a ETF guy, that's fine. I also believe that you're always gonna have some cash on the sideline as long as there is a chance of a stock market softening up, as well as T-bills. And I'm gonna go through all that very quickly with you guys. Now, eventually I'm gonna make another video to go more in detail on what I'm saying today, but regardless, guys, you have to understand that stocks go up historically, but when you listen to someone saying the stocks go up, they refer to the S&P 500, not to individual stocks. Every time people say stocks have overperformed bonds or stocks have overperformed real estate, what they're actually saying is that the S&P 500 has overperformed or outperformed real estate. There is no individual stock that you can make the same statement. And that's the reason why I do believe that having a portfolio only of individual stocks is very risky. Because if you have 10 stocks and one of them goes to zero, well, now you have 9, okay? If you buy an index or an ETF with, let's say, the top 100, the NASDAQ 100, and one of them is gonna go bad, well, then that one stock is gonna be replaced with another one, and you still have 100 stocks. Now, like everything else, it's got pros and cons. I'll say that I am not the hugest fan of buying index funds, ETFs, even though, yeah, I do. I have a whole bunch of those. The reason being is that you want to buy when a company is down, stock price are down. Like Warren Buffett always says, be greedy when others are fearful, and be fearful when others are greedy, of course. And now the problem with that is that if you buy the S&P 500, now the S&P 500 as of today, I believe it's got a huge chunk in Nvidia, for example. Now Nvidia, I believe that it's possibly 8-9% of the S&P 500, but the way they do it is that every quarter they rebalance their portfolio, and if the price of Nvidia goes up, well then they are going to buy more Nvidia. If the price of Microsoft goes down, well then they are gonna to adjust the percentage of Microsoft in the S&P 500 and sell some of it. But if you think about it, it's actually the opposite of what anyone in the right mind would do. Like I would buy Nvidia if it drops. No, I wouldn't buy Nvidia if it doubles in price and I'm gonna go out there and buy twice of my current position. But that's exactly what index funds do. So I'm not saying the index funds are bad, but I'm saying that you gotta be aware of how those financial vehicles work. Now, index funds are a great option, especially if you want to be a hands-off investor. And in this portfolio, you'll see index funds, ETFs. But you want to be aware that you're going to make much more money buying individual stock. Is that you gotta buy them at the right time, and the right time is when individual stocks are cheap. Notice something, I didn't say buy individual stocks when they are less expensive. I am saying you gotta buy individual stocks when they are cheap, and in order to evaluate if individual stocks are cheap, you have to look at the index. So I will only buy individual stocks of a good company, and I'm gonna show you now what it means good company and what individual stocks I have in this portfolio. But you're only gonna have to buy those when the S&P 500 drops. At least you gotta be 5-10% at least from the highs. Or better, you wait for a correction to buy individual stocks, or better off, you wait for a stock market crash. Because what happens is that a lot of people buy lump sums of individual stocks when this index is at all-time highs, and then they're gonna be stuck in the red for 1, 2, 3, 4 years. And all of this is gonna be applied in this portfolio. Remember, there is always a time and a place for everything, okay? Now, your duty here is to take the temperature of the stock market. Now, notice something. I didn't say that you need to evaluate if the stock market is high priced or it is overpriced. By the way, overpriced is a word that you might want to take out of your dictionary, because there is no way that anyone can make a statement that the stock market is overpriced. Now, you might say that stocks are high priced, but it seems that every time that stocks are high priced, they're gonna get more high priced and more overpriced and more overpriced. And the same thing when the stock market seems to be cheap, it's always gonna get cheaper and cheaper and cheaper. So your duty here is to take the temperature of the stock market. Now, how do you do that? Now here I have two indicators. Now one of them is the Shiller Cape ratio, and the other one is the Buffett indicator, of course. Now, if you look at the Shiller ratio, basically we are so close to the all-time highs, and this is the all-time. And what history teaches us is that every time you buy stocks, and by stocks I mean the S&P 500 at this level, your return on investment over the next 10 years was going to be either negative or 0 or 2% maximum. So does it really make sense buying stocks? Does it really make sense buying S&P 500 or individual stocks when the Shiller Cape ratio is at all-time high? I wouldn't think so. I would be more comfortable buying a bond. A bond, it's going to return you 7, 8, 9, 10% and more if you buy junk bonds, and you're going to be sure that your return that year is going to be 10%. Now, I truly don't believe that if you buy stocks with the Shiller Cape ratio at the all-time highs, you're going to return 10% on your money over the next year. Because again, history teaches us that your return is going to be close to 0 if you're lucky, or it's going to be actually negative. Now, here is the Buffett indicator. I'm going to pull it up. And the Buffett indicator says that right now we are really close to the all-time highs on that, and that is a percentage of the total market capitalization, market cap of the S&P 500 divided by the GDP of the United States. And right now I believe we are over 220. So for that reason that I'm gonna go back here. Now for that reason I'm saying that stocks as of now, they are high priced. Can they go up and go up a lot? Yeah, but the probability, or rather the odds, are against you. This is like you are at the blackjack table and you have a 17 and you hit. You know, yeah, you can get lucky and get a 2, a 3, or even a 4. But what is the chance? There is a bigger chance that you get a face card or a 10 and you're gonna be eliminated. So right now I'm gonna show you guys what I do now as individual stocks. Basically what I'm trying to say is that you take the temperature of the stock market. Let's say temperature is from 1 to 10. If the stock market is an 8, a 9, and a 10, I would stick with T-bills. If the stock market is a 6, 7, 8, or let's say 7 or 8, it's still hot, but it's not too hot, I would buy bonds. If the stock market is gonna cool down a bit, I'm gonna buy dividend stocks, because you can get a good price on a dividend stock. In that case, the yield is gonna go up, and I'm gonna buy 2 ETFs, including a covered call ETF. And when the stock market is down, like it's a 5, I will buy individual stocks, growth stocks. And if the stock market corrects, gets into a correction, or if the stock market gets into a crash, well then I would buy more of those individual stocks, and I would buy leverage ETFs. But when I buy leverage ETF, I only buy the TQQQ, which is the triple leverage Nasdaq ETF. I would buy SSO, which is the double leverage S&P 500 ETF, and I will buy SPXL, which is the S&P 500 3X ETF. But I will only buy those when the market is really deep into a bear market. So once you do that, really it's gonna turn into a little game. It's gonna turn into a piece of cake. Like right now, today, stock market was Friday near or at the all-time highs. Today finished, I believe, in the red, flat. So today I bought T-bills. Now the good thing about the T-bills and short-term income ETFs is that they stay pretty stable, and they pay you 4% annualized. And if you buy those, I believe that you're gonna have tax breaks. Now you can buy municipal, they still pay you a 4%, and sometimes you are tax exempt if you buy muni of your own state. But regardless, my point is that that is gonna be your dried powder for anything that happens. You're gonna have the T-bills, and you're gonna sell those at the right time, and you're gonna convert into individual stocks, or if the stock market crashes, you're gonna sell those and buy leverage ETFs that track the index fund. So let me go through this. In my personal opinion, you really don't need, again, more than 3, 4, 5 individual stocks of good companies. And by good companies, I mean, I don't buy companies that are the flavor of the day. So right now you got AI, which is you got memory, like a SanDisk, which is I will stay away from the hottest stock in the hottest sector. So I buy conventional companies. I buy stocks like Schwab. This is the first one, Schwab. It's a very good company, very profitable company, growing revenue, and it's a company that everyone knows and everyone uses. Now the other one, individual stock that I have is Pfizer, which I use that to collect dividends. And I also, at the right time, I sell cover calls on that. So I collect the premium and I collect the dividends on Pfizer. The other stock that I have is MasterCard. MasterCard, I believe it's a great company. It's a duopoly with Visa. I do believe that it's going to be a good company in the future. Even with crypto, they're going to adapt to that. Now, talking about individual stocks, again, I have Google, which is possibly my #1 pick. Those are 4 stocks. Progressive insurance, because people always are gonna need the insurance, regardless of what the market does, regardless of the pandemic, war. People always are gonna need the insurance to drive a car. The other one is MO, which is Altria, and again, as same thing which I did for Pfizer. Also, I have Verizon for the same reason. I have Realty Income and EPR. Those are great dividend-paying stocks that when the market drops, those stocks, they don't move a lot and they keep you alive with the dividend. Also, I buy EPR, which is a real estate company which pays a high dividend and it pays monthly. I do the same strategy with Verizon, which is in here, and with AGNC, which is right here. Those are great companies, stable companies. Real estate is not going anywhere, and they pay you monthly or quarterly, so that if in the case you're gonna lose money in your individual growth stocks, you are gonna have the dividends that are going to keep you afloat. At the same time, you can sell cover calls against them and make extra income with the premium. Okay, those are my individual stocks. Also, I buy ETFs, and primarily I buy BUCK, BUCK, This is a high dividend ETF that they make money by buying treasury bills and buying, of course, the different types of treasury bills, long-term, short-term, primarily short-term, and also they sell covered calls on the S&P 500. And I believe that they pay 7-8% dividend, which is pretty safe. The other one ETF that I have is SPMO, which is the Invesco S&P 500 Momentum ETF. I believe it's great. It has overperformed all of those SPY, all of those large cap S&P 500 ETFs with consistency. So I replaced SCHG, SPY, VUG with the simple SPMO. The other ETF which I buy is JEPQ, which pays a 10% dividend, and it is great, especially right now when the market is high and the market is going sideways. Now, if the Nasdaq was to shoot up, you might be better off buying the QQQ. But how do you know? No one has the crystal ball. And if you look at the total return of the JEPQ, including dividends and including appreciation, of course, reinvesting the dividends on JEPQ, you are going to outperform the QQQ in the long term, under the assumption the market is going to go sideways. But guys, the market is at all-time highs. I believe it's gonna go sideways for a while. Again, the other one that I have is SSO, which is the double leverage ETF. Now, those ones, you buy those during a stock market crash. SPXL is the same thing, but it's a triple leverage ETF. You buy there if the stock market really gets into a crash, because when it goes back up, you are gonna have the power of the triple leverage ETF. Last but not least is treasury bills. And treasury bills, guys, I buy 2 treasury bill ETFs. And which are they? Are BIL, which is the short-term treasury bill ETF from State Street, and it pays you 4% annualized, and usually ex-dividend date on there, it's the first of the month. And I buy TBLL, which is the same thing. This is the short-term treasury bill ETF from Invesco, and that pays you around the 23rd, 24th of the month, depending on each month, and they pays you nearly 4%. They charge you very little as an expense ratio, and the good thing is that you're gonna get income which is scattered a little bit, but you are not gonna have to worry about income once you get in this portfolio. You have AG&C paying it at 10%, you got JEPQ paying a stable 8, 9, 10%. And Verizon paying you a 6%, and Pfizer paying you 6-7%. So, like you guys can see, why do I say that this is our all-weather portfolio? It is because if the market drops, you're gonna have the opportunity to buy more shares at a lower price, like you buy JEPQ at a lower price. And how do you buy that? You buy with the T-bills ETFs. You're gonna sell a little bit of those. Again, T-bill ETFs, they are your dried powder. Or if you want, you can leave 5-10% of your portfolio in straight cash. You don't even buy treasury bills. But guys, when you are at the all-time highs, and the history teaches us that you're not gonna make over 2% over the next 10 years, and here you have an options with T-bills to make 4% a year, I think this is a no-brainer, because all of those others including JEPQ or including Verizon or AGNC, all of those other stocks, they might drop if we have a broad market stock crash. But if you buy BIL or TBLL, they keep the price very, very, very consistent. Now, again, I got the triple leverage ETF. I also buy not only the triple leverage S&P 500 ETF, I also buy the TQQQ, which is of course the triple leverage Nasdaq ETF. You might want to buy those only when the market tanks. Like I believe the SPXL today is trading at about $240 a share, but it was trading not even a year ago at 90. So if you can be good at, you don't have to time the market. Again, you gotta take the temperature of the market, which is not the same thing. If you can buy SPXL around the market bottom, well, you're gonna then make a killing when the market goes back up. The same I could say for TQQQ. And last but not least, I have a couple of junk bonds. Those are your FLBL or your JNK. Those are bonds that usually they drop a little bit over time, but they pay you 7, 8%, 10% income, and those are a good income when the stock market crashes. And if your dividend stock crashes too, usually bonds are gonna go down, but not very much. So that's gonna keep you afloat. And it's about the same thing as a treasury bill concept. The thing is that treasury bill pays you only 4%, and junk bonds are gonna pay you, it depends, you know, there are 7, 8, 9, 10%. There are funds that pays you even 10, 15, 20, 25%. But in that case, you know, you're gonna go experience probably some principal erosion. But other than that, if you can, every time that you invest, like if you decide to invest $1,000 every first of the month, well then all you have to do is take the temperature of the market and come up with the right percentages of how to allocate your capital within this asset classes. Okay, so I would say that for the near future, with the stock market is ahead of itself, we're still in a war, guys, and there is a lot of misleading information of what they're gonna do. One day the Strait is open, another day the Strait of Hormuz is closed, oil spikes up, the other day oil drops. You don't really know what's going on, and no one knows. And this war can be still for the next few weeks, if not month. So in this case, I do believe that the stock market still has a down way, and no one knows how bad it's gonna get. So right now I am buying treasury bills. I'm happy buying treasury bills. And again, if it was to go down a little bit, I would put a little bit of money into JEPQ or into individual stocks. If it drops further, if it drops even further, I would buy individual stocks of growth companies. They're all good companies. If I buy an individual stock, they're all gonna be good company. Like I have Google, JP Morgan, MasterCard. Those are my 3 long-term picks of good companies. Individual dividend paying stocks, I already teach you guys. It's Altria, Realty Income, EPR, AGNC. Those are good company stocks that you can collect the dividend and sell covered calls against them. And then again, if the stock market was to have a deep correction or a huge crash, you got your leverage ETFs that they are gonna make you a killing when the market goes back up. But even if it doesn't, for some time, you still have the income from the treasury bills, the 4%. You have income from FLBL, which is a senior note, or rather junk bond. You're gonna have income from your dividend paying income, and you're gonna have income selling covered calls and collecting the premium. So I think that I'm gonna wrap up. If you have any question, feel free to reach out. This is gonna be only the first of a few videos to show you guys how you can sleep good at night, and you don't even have to check the markets. Once you start doing that, you're not gonna have to check the market once a month, but you have to do your homework. You have to think with your own head, and you gotta stay away from all the thoughts and the FOMO and the flavor of the day. So again, I appreciate you guys for watching. Let me know if anything else that you guys want me to talk about it. Have a great day, and happy trading, everyone.